The world of finance has recently been electrified. Official approval has been given to XRP ETFs, a momentous event that ushers in a new age for institutional investing and digital assets. The approval to introduce spot XRP ETFs has been granted to BlackRock and other prominent asset managers. Additionally, the market's early response has been nothing short of spectacular. According to insiders, approximately $30 billion has poured into these recently created ETFs in the first 7 days, causing a parabolic price spike that sent XRP straight up to $1,000 from its previous trading level. This isn't just hype or conjecture, it is a methodical, structural reaction to a demand factor convergence that has never been seen before. Because XRP combines institutional compliance, real-world utility, and scalability, the initial demand shock is considerably more strong than it was for Bitcoin or Ethereum, which had ETF-driven price accelerations in prior years. Banks, hedge funds, and large trading companies are rushing to buy XRP in order to satisfy transactional and settlement requirements, as well as to increase portfolio exposure. Thus, a perfect storm has been created by the approval of these ETFs. The asset is now a tradable, regulated product that may be concurrently incorporated into reserves, settlement processes, and portfolios in addition to serving as a cross-border liquidity tool. To be honest, the size of the influx is astounding. With the exception of the significant Bitcoin ETF launches, the amount of $30 billion in just 7 days was essentially unthinkable in the cryptocurrency markets. However, the infrastructure and usefulness of XRP actually enable it to take in that kind of cash, with a level of effectiveness that is simply unmatched by other resources. Institutional players are attracted to XRP due to its operational requirement as well as its potential for financial gain. ETF exposure ultimately functions as both an investment and, well, a strategic reserve, as international banks utilize RippleNet and on-demand liquidity for cross-border transfers more frequently. This is being referred to some market participants as a tsunami of liquidity. With each billion-dollar buy, the upward momentum is increased, generating a feedback cycle in which price appreciation actually fuels urgency, which in turn simply attracts more inflows. The rapidity at which this parabolic increase occurred, just 7 days from ETF approval to $1,000, is in fact unparalleled, according to observers, and it clearly shows how XRP's practical use boosts institutional demand in ways that Bitcoin and Ethereum simply cannot. The fact that this event is being compared to previous Bitcoin and Ethereum ETF launches actually highlights how unique it is. The size and intensity of the demand for XRP differ from those of Bitcoin and Ethereum, which experienced more steady price hikes following ETF certification. In order to provide liquidity and settlements, banks and other financial institutions are operationally required to possess XRP. They are not merely engaging in speculation. Several important catalysts are being identified by industry insiders as the cause of this parabolic increase. First, regulatory clarity brought about by the ETF clearance itself enables billions of dollars in institutional capital that had been reticent to enter the market to do so safely. Second, the ETF form makes it possible to purchase XRP without compromising on-chain liquidity, allowing for a significant capital deployment without upsetting the current market. Third, every unit of XRP purchased for ETF exposure is instantly acknowledged as a vital operational asset, thanks to Ripple's continuous collaborations with banks and payment processors, which further tightens the supply-demand dynamic. Several sources claim that the $1,000 price target that was met in just 7 days is not a projection. It displays the current structural imbalance brought about by limited tradable supply, utility-driven demand, and inflows. Analysts stress that XRP's liquidity and market capitalization have always been strong enough to withstand inflows of billions of dollars. But the combination of utility-based demand and ETF approval generates a velocity that is truly unheard of in other cryptocurrency markets. The parabolic increase was characterized by traders as a perfect storm, when institutional acceptance, operational necessity, and regulatory clarity all collide in a relatively condensed period of time. Every significant exchange, custodian, and fund manager is rushing to distribute XRP. And to be honest, the ETF launches operate as catalysts for a situation where supply and demand are already constrained. It is impossible to overestimate Wall Street's influence. BlackRock, Vanguard, and other elite asset managers have successfully established XRP as a legitimate investment option. The first investment of $30 billion is just the beginning. According to insiders, banks, hedge funds, and sovereign wealth funds are already making follow-on allocations. Since each participant must purchase XRP in real time to preserve ETF exposure, liquidity coverage, and operational compliance, this coordinated adoption intensifies the parabolic trajectory. Although traditional ETFs have occasionally caused fairly quick inflows, analysts are making some intriguing comparisons to previous market events. However, the combination of XRP's operational utility, regulatory approval, and that extremely concentrated initial allocation is causing a market shock that is, to be honest, simply unheard of in terms of both scale and speed. These market dynamics are revealing some deeper ramifications for the entire cryptocurrency ecosystem, going beyond just the numerical spike. At scale, XRP is currently being positioned as the link between digital assets and traditional finance. Investors in exchange-traded funds, ETFs, are now exposed to an asset that is truly utilized in banking operations, as well as cross-border settlement liquidity management. This is now a genuine functional stake in the global financial system rather than merely speculating. Network effects are accelerated by this adoption, according to observers. Banks must retain more tokens to conduct transactions as ETFs increase demand for XRP, which lowers the amount of tokens in circulation and raises prices. In just 7 days, the market saw an epic compression of liquidity, with billions of dollars that had previously been transferred through traditional fiat settlement channels now going into XRP, solidifying its newfound position as a financial and operational pillar. This event's magnitude and pace also demonstrate the institutional players' strategic vision. Top-tier banks and asset managers acted right away after regulatory permission, using meticulously planned allocation strategies to capture both financial upside and operational utility, rather than waiting for gradual adoption or speculative excitement. These carefully planned purchases, smart contract interfaces for liquidity management, and coordination across ETF and operational channels to ensure a seamless transition into XRP exposure are all detailed in internal memos that have been leaked from significant institutions. Together with market-making tactics, these moves ultimately played a part in the explosive parabolic rise that saw XRP reach $1,000 in just 7 days. Analysts are pointing out that an extremely intense feedback loop is created when ETF inflows and on-chain liquidity demands work together. During the introduction of their ETFs, Bitcoin and Ethereum essentially never encountered this. It only draws attention to the genuinely exceptional position that XRP holds at the nexus of institutional adoption, operational necessity, and regulatory certainty. There is more to the 1,000 milestone than just a cost. To be honest, it's a sign of change. In addition to showing investor confidence, the first week of ETF inflows confirms that XRP is a fundamental financial tool that can process billions of dollars in real-time transactions. These days, banks, asset managers, and trading desks view XRP as more than just a cryptocurrency. Rather, they regard it as a useful, regulated, and operationally essential asset. Insiders say that the structural need for XRP and banking operations, along with ETF-driven capital, has generated a velocity of demand that may continue to drive considerable price activity in the weeks after the initial approval. Although volatility is unavoidable, market watchers see that XRP's basic support has irreversibly changed. It is now an essential part of institutional portfolios and the infrastructure supporting global settlements, not just a speculative tool. You are aware that the wider ramifications go beyond finance to include operational and regulatory areas. Other institutional-grade products, like as corporate treasury instruments and derivatives futures, are anticipated to follow when XRP ETFs are legalized, which will hasten adoption